All right, that's what we wanted. Sorry. Okay. Sometimes those buttons are just hiding somewhere. All right, couple of words from me. Best Review Leaders Issue provides information on U.S. life and health insurance. This is ranked in 2020. According to Best Review Leaders Issue, we are on number 186. I'm very excited.
Congratulations.
Thank you. Congratulations to you too. We're very, very excited because those are all the companies in the United States, which I think we're doing wonderful. And we also would like to report to you that for the period ending June 30th of 2021, we have some very nice figures in life insurance and also outstanding in annuities as well too. That is why Tom and we would like to thank you very much for your hard work and keep it coming.
Absolutely. Again, thank you for being with us today. AM Best is a huge industry rating company, and they have the best review, and they put out a leaders issue once a year, and they have the top 200, and we fell into the top 200, which is a good thing. We got our name in the magazine. We'd like to bump that up a little bit, but there's about 700 to 750 insurance companies out there. So we're doing okay in terms of the other competition. So thanks for all that you do out in the field, and keep up the good work.
Thank you. I would like to remind you about our annuity rates. Sometimes, there was a change in rates. That's why I think it's quite important for us to keep those numbers, those percentages in front of our eyes. Our PNA, single premium deferred annuity, lifetime annuity that we offer with minimum of 5,000, that rate is 2.25 for a first year and 2% for remaining 4. Our 8 years, also lifetime annuity, provides interest rate of 2% for the first year, and after that it could change. Of course, our guaranteed rate is 1%. That means it cannot go lower than a 1%. Also, we have the 2-year annuity contract. If it's below 50, that's 1.15. It's $50,000 premium, or the account balance. It's 2%, which is also guaranteed in the first year. We are getting ready for a new issue of Skoda magazine, and we would like to provide to you back to school offer, Buckle Up for Safety. This offer presents a term to age 25. Term to age 25 is not as, I see in between the agents that they're not familiar as the regular our 20K life or a single premium for kids. We do still offer that product. It's a term policy for the kids. We're in this offer. We have 25,000 coverage for $35 per year for a male or female, and 50,000 for $70 per year for male or female. Also, please note that this term to age 25 does not qualify that, as I'm saying, it does not qualify the child for any fraternal benefits that PNA has to offer. Tom?
Yeah, we're actually doing it. It's a twofold promotion. Buckle Up for Safety, Buckle Up for the Future when we talk about the future, that with this term to age 25, what does lock-in insurability today mean? And this, what we're looking at is the future insurability of the child. If you get like a 5-year-old child and put the term to age 25, they can convert that to a permanent life insurance policy at any point up to age 25. So that actually protects their insurability up to age 25. Now, the other part of it is that we will be also promoting a life insurance policy, either the life paid up at 90 or the life paid up at 65, with a guaranteed issue rider. Now, the guaranteed issue rider that we have gives the insured, so it's a whole life policy. And it gives the insured the option of purchasing additional $25,000 policy at ages 25, 28, 31, 34, 37, and age 40. So there's 6 additional options to purchase $25,000. So that's a total of $150,000 in addition to the initial policy. And that's how you protect a child's future insurability. So with the term to 25, it's kind of a door opener. And if somebody, and what we're going to do is we're going to work with the agents on this, because if someone applies for a term of 25 and it's in your area, we'll get that to you. And then you can go in and try to convert that to a whole life, whether it's a 25,000 or a 50,000, you can go in and convert that to a regular policy, a whole life policy with the guaranteed issue rider. So it's kind of a door opener. And we're looking at it that way, and hopefully it will lead to, it will lead to additional sales of the whole life plans.
Thank you. Couple of friendly reminders. As I was telling you before, Skoda magazine is Ms. Kutlinska is working on our Skoda magazine for the autumn issue. Please, if you have any articles that you would like to submit, or picture, or you have new members, especially children, I know it's quite popular, like with my clients. Please do so. Also, if you're changing your address, if you're changing your email, if you're changing your phone number, please let us know. That's quite important, that we could update our database. Also, license. If you have your license renewed just recently, provide us a copy. This will save us, looking at NIPR and getting that information. Some of the states would not let us get a copy of the license, but you are able to do so. That means please provide us that information. In respect to with the agent from the Chicago area, what's going on in Chicago right now, we have pro bono legal services that are offered here in the PNA office. We have a shredded event on August 7th. That will be happening also here at the PNA. And we also going to have a car show on August 29th of 2021. That means we have our calendars finally is filling up. Also, I would like to mention to you that I'll be going to Poland on little vacation for 16 days. Tom, are you happy about it? Or?
Yeah, well, I asked her to take me with her, and she said no. So what are you gonna do?
But I'm going to Poland. That means if there is something that you would like to discuss, Tom, Halina, Bart are here to help you. That means please do not hesitate to kind of let you know that I will be in Poland.
Okay.
All right, and now we are ready for Tom's presentation. Let me just jump in the other PowerPoint.
Yeah.
second. We are almost there. All right.
All right. Well, again, thank you for being with us this afternoon. We have the Yola and Tom show broadcasting live to you from the Polish National Alliance home office in Chicago. So let's get started. I know we had covered the dime needs analysis a couple of months ago, and I wanted to do talk about it again because it's actually a really great tool for determining how much insurance a person needs. And really, there's three questions to answer when we're talking about life insurance planning. The first question is, do I need it? Second, how much should I have? And three, what kind should I have? And I've actually said that to people when we're talking about life insurance, and I just sit there, and that's my segue into a conversation about it. And I just say, well, there's really three questions we need to answer today. Is first of all, do you need it? How much should you have, and what kind should you have? So, do I need life insurance? Well, if someone depends on you for financial support, you're going to need some life insurance. And the questions are, is anyone dependent on your income, whether it's the kids, the spouse, parents, might be grandparents. It might be a disabled person in the family. It could be a special needs person in the family. So do you have a mortgage on your residence, or do you have a rental fund? So that if something happens to you, your family can stay in the house, or they can stay where they live and make some sort of recovery. Are there any loans, debts, or other financial obligations? And almost everybody has some kind of credit card debt, or car loan, or student loan. And I've seen a lot of people, parents, purchasing insurance for the kids, where the kids wind up with $30,000, $40,000, $50,000 of student loans. And it's not a great situation, but there's almost funding college these days is not easy. Will your children need funding for college or technical school? Do you have final expense covered by savings? And that's a really expensive way to cover your final expenses, because you can have life insurance and it's a lot cheaper. And in a business situation, if you're in partnership with somebody and that person dies, what are you going to do for the family of your partner? How are you going to buy them out? Life insurance can take care of that very, very nicely. And we'll talk more about that later on this year. So why do people buy life insurance? Well, the major reason is for burial and final expenses. And my mom died 5 years ago, and we went to the funeral home and we went through all the expenses, and it added up to $17,000 very, very quickly. And she had already paid for the plot, cemetery plot, and also the headstone. So it was $17,000 right away without even those things counted. And it's different in different parts of the country. But burial and final expenses is something that weighs on people's minds. Replace lost income for survivors. Your family. What's family going to do without your income? Pay off the mortgage. Are they going to have to move into a smaller place or move into an apartment? Do you want them to be able to stay in their own home? Home expenses, tax advantage investments, estate taxes, pay for college is down there toward the bottom, but that is on people's minds, people who have young children at this point. So anyway, these are the reasons that people buy the insurance. The dime conversation covers the first three very, very nicely, and it gets into paying for college. So Is there an easy way to determine how much life insurance? Okay, so do I need it? Yeah, the chances are very good that you do. Secondly, how much do I need? And how do we determine that? Well, there's a rule of thumb, and the rule of thumb is a multiple of income. And when I was an agent, way back when, we used to use 5 times income. And that really doesn't cut it anymore. I know for underwriting purposes, underwriters will look at up to 20 times income. So there's been a big jump, and it needs discussion. It needs taken a look at. The quick analysis that we're going to talk about is DIME, and that covers debt, income, mortgage, and education. We do have access here in the home office to comprehensive needs analysis if you need it. Financial need analysis. We can do a lot of different things. We can also do business needs analysis and executive needs analysis. So business valuation is another thing that we can help with. So there's a lot of things that we can do as agents, and the DIME analysis is really one that comes into play with our members and with the people that we talk to. So this is what it looks like. It's on the website, and I will send one out to everyone on the next Monday morning message so that you have it and you can print it up at home. I'm trying to get to the point where we can do a PDF that's fillable so that up in the right-hand corner, you can put your name, phone number, and email address. So the example that we're going to use today is Mr. Prospect, who's age 37. He has an annual income of $65,000. Mrs. Prospect is 36 years of age, and she has an annual income of $35,000. The reason she has a $35,000 income is that she works part-time. They have two young children, and she is home part of the time with the kids. We'll talk more about the kids in a moment. So the first questions we ask on the DIME is that we cover the debt. Do you have any revolving credit? Well, these folks don't have any credit cards, and that's a good situation to be in. They have an auto loan for $12,000. They don't have any student loans, and that would be student loans on themselves and possibly their children. And burial and final expenses. And again, we use a number of $20,000, and that could be, that's a number that they have to come up with. So we're using their numbers as we go through the DIME analysis. I go down to mortgage. Some people go across to the right and do income, and that would fit with DIME, but for some reason I like to go down with this, and that's what I did, so bear with me. So the mortgage, how much do you own on your home? How much do you owe on your home? And they owe $140,000, but the next question is, how much would you like to provide as a benefit to your family? Well, it could be 100%, it could be 75%. The total amount needed, though, they chose 100%. We're going to go with $140,000. Okay, income. And this is where the discussion comes in. So how much annual, the question is, how much annual income will your family require if the primary earner dies? Well, down toward the bottom there, I'm trying to use the pointer as a pointer. Financial experts generally recommend 70% of the current income while there are children living at home. So they make a total of $100,000. 70% of that is $70,000. So the annual family income need is $70,000. And you multiply that times the number of years till the youngest child is age 18. So we've got 12 years in there because they have 2 kids, ages 8 and 6. So the total income replacement in that scenario is $840,000. Well, the wife works, and we see that her annual income is 35,000. So if we subtract that from the total of 70 that we need, we come up with 35,000. 12 times that is 420,000. Okay, so that is the income need, and the objective is to cover that need also. Education, and again, public in-state education, the average is about $22,000. Private is about $50,000. And again, that depends on where you live and where the kids are going to school. And you know, college is, not everybody thinks college is necessary, and that's okay. But don't you want to have that option if the child wants to go to school? And it's impossible for a child anymore to be able to work during the summer and pay for college things. I know that I worked during the summer and I worked during the school year, and I was able to pay almost all of my college tuition. But that doesn't happen anymore. The college costs are way too high for kids to be able to work and pay for it. So there's got to be other sources of income. So the Mr. and Mrs. Prospect decided that they wanted $200,000 there for their two kids. And that's $25,000 a year per child. Okay, so the next thing we do is add all of that up: the debt, the mortgage, the income that's needed, and then the education. And that total estimate is $1,212,000. Now he's got, at work, he's got 2 times income, which is $130,000. And up until now, that sounded like a lot of insurance to him. Okay, $130,000. But that really just touches the surface. So the current shortfall is $1,082,000. And the next thing that he's going to say is, wow, that's a lot of money. And my response to that is, well, it's your numbers. You gave me the numbers. And where would you like to cut back up on top there? Where would we need to cut back? Well, you know, if the wife works, we could maybe do 662,000 total, because we would subtract some of that 840,000. So then we wouldn't need as much. But if you don't want to cut back anywhere, your number is $1,082,000. So if we could take care of that, the debt, the mortgage, the income for your family, the education for the kids, what could you pay on a monthly basis? And not take food off the table, but and that's what I call a premium commitment. I don't say that to the client, but how much could you put aside on a monthly basis? And the number that I received here is between $100 and $125. Okay, so $1,082,000 for a 37-year-old male, 20-year renewable term to age 95 is $101.05 a month. Okay, most people think that insurance costs a lot more than it does. But if something happens to him, we will come to his spouse with a check for over $1 million. And to get that, we need to have a monthly premium of $101. Okay, and if we go to the lower amount, so we've stayed within his budget, $100 to $125. If we go to the lower amount of $662,000, it's going to cost him $62.88 a month. So again, if something happens to him, we walk in with a check for $662,000. So we can take care of all of his needs, all of his family's needs, for $101 a month. That's a powerful thing to be able to do. Let me go back to that just 1 second. So the next question is, and I would just ask him, you know, is is $101 coming out of your checking account okay with you? And then I would start on the application. When you run this illustration form, you have access to the e-application, and you can go right into an e-application, and we can do an electronic signature. And we can we take money on that? Yeah.
They could actually go online and pay. There's an option for online payment, and those proceeds could come for that application, for that online application, just the client completing the payment online. When just instruct the client that whenever they're being asked for the policy number, just put new application, and that would be connected with that application. The money will be connected with the application.
Yeah, and Yola went through that a little bit on the last session that we had. But if you have any questions, just call us and ask us. But this is a real easy. It's a nice analysis. It's an easy way to talk to the people, and it's also, like I said, you're getting their numbers. It's not your number. And you're taking care of their concerns and what their goals are for their family. So there's other considerations when you do a needs analysis. There might be a special needs situation where there's a special needs family member. They might want to put some money aside for retirement, and you can use sometimes you can use a whole life policy for that. Business succession, I mentioned that earlier. What happens if a partner dies, or a key employee? And we also have ways of doing deferred compensation through life insurance. But again, we will talk more about those things as we go through this year. So the next question is, what kind should I have? Should I have all term? Well, you could see in our illustration that we took care of his need with term insurance. There was a little money left over, but not much in terms of the premium. But should I have all whole life? Well, that might be a little expensive. One of the things that we've been talking about, I mentioned it in the last article that, and we've been advertising, is the blended solution, a combination of whole life and term insurance. Once we have the premium commitment, if he had told me $150 or $175, I would have been able to take that $1,082,000, bring it down maybe to $1,032,000, and provide $50,000 of whole life insurance also. And what that does is it gives him a whole life policy that's going to last all his life, and the term insurance on top of that takes care of any needs that his family has, and that's a 20-year term. So at the end of 20 years, he may not need it at the end of 18 years, or he may not need it at the 17th and the 17th. So once you have the premium commitment, you know what you can do in terms of delivering a product to this person and covering the needs. The need is what's critical. Once we develop the need and then we get the premium commitment, we fit the product into what the premium will pay for. So again, with the blended solution, we determine the need with time. We ask for a premium commitment. How much can they afford? All term, all whole life? Should we make a combination? The blended solution is whole life, and the advantage is whole life with term. And the advantage is the permanent cash value life insurance policy, plus they have the rest of the need covered with low cost term insurance. So any questions about that? Okay, again, it's a conversation that we need to have with people. We know, people we know, love, and serve are the ones that we need to give the best service to. And a dime analysis is it's a big help to people, and they feel good once they've gone through it and know that they've got stuff taken care of. And I tell people, I say, they want to get into the stock market, they want to do this, that, and the other thing. I said, well, look, let's get this taken care of first, and then you can speculate all you want. You can do anything else that you want with your money because you got your family taken care of. So, okay. There's a number of online sites that have needs analysis in them. We have access, as I mentioned before, we have access to a number of needs analysis here in the home office. The DIME approach will get you really close to what people really need. But if you need something more complex, we're able to provide that for you. And Yola mentioned earlier that if you have questions, give us a call, but that goes across the board. If you have questions about ownership, beneficiaries, in how to set a plan up, or how to fill out the app, how to use the e-app, whatever it might be, how to run an illustration, we are here in the home office to help. Helena, Bart, Yola, myself, we will answer the telephone and answer your questions. And if we don't know the answer, we'll get it for you. That happens more often than I would like, but I will get back to you if you need some information. Okay, any questions? All right, this is kind of a neat thing. You know, we have a really good single premium whole life policy, and I'm sure a lot of you have sold that policy. But I've looked at it, and I've looked at competition, and our policy is a really good competitive policy. But this is a great approach. If somebody's looking at purchasing an annuity, they have some money coming out of a CD, or they've got an annuity with some other company, and they want to talk about doing something with that. This choices interview is a really good interview, and it's a way to leverage the client's dollars and keep those dollars secure and available. So an alternative for annuity buyers who have non-qualified money and who are insurable. And if we go in, lots of times people will go in, agents will go in and say, hey, you know, I'd like you to take a look at the single premium whole life. I know you want an annuity, but, well, the first question to ask, or the first statement is, we're here to talk about an annuity. Okay, so you set them at ease because they know that you will be talking about annuity. But before we start, I'd like to ask you a couple questions. Oh, okay, go ahead. So the first question is, are you saving this money for something you need, some short or long-term goal? Okay, if they have a specific need for this money, then you're not going to have a conversation about single premium whole life. The product just won't fit for them. The second question is, what about the interest earnings on this money? Are you going to use it, or are you just going to let it keep adding up? And most people, when they purchase an annuity, leave the money in it and they let the money accumulate. If you're not going to spend it, what's ultimately going to happen to it? Well, that's a good question. I want some to go to the kids. I want some to go to the church, my alma mater. Okay, so you're not going to use it because it's just going to sit there, and at some point in time, it's going to go to the kids, the school, whatever else there might be.
Sorry.
I don't know who's calling. Okay, so what's ultimately going to happen to that money? If you're not going to use it for anything, any special reason, but still want to have some control, let's look at what your choices are. Okay, so we're talking about the choices interview here, and this is what your choices are. Choice number one is bank accounts, and the different kinds of bank accounts. And we kind of use that as a general term, but that includes passbook savings, certificates of deposit, money market accounts, anything that has interest income, and that interest income is taxable. So safety. Okay, deposits are federally insured up to $250,000. You have liquidity. Depending on the type of deposit, you have easy access to your funds. If you got a CD, you may have an early withdrawal penalty. Flexibility, you choose the terms, you choose 5 years, 10 years, whatever you want. And there's a good rate of return. And I put a question mark behind that because it hasn't been such a great rate of return recently. The interest rates on our annuities are far better than what you can get at a bank at this point. This choice number 2 is the annuity. And that's what we were talking about for you today. Safety, your funds are backed. It's a purchase. It's an insurance policy. An annuity is an insurance policy. So your funds are backed by the financial strength of an insurance company. And insurance companies have legal reserves that they have to set up. And they have to reserve for the money that you have put with them in terms of an annuity. Liquidity. You still have access to your funds if you need them. You can get the money out of an annuity if you need it. Flexibility, you can choose the terms of your contract. And you know what else? In an annuity, there's a guaranteed lifetime income option. So that's something that they can't do with the bank account. You have a lifetime income option, and you have an income that you never have to worry about. Competitive rate of return, often higher than those offered by banks. Another feature is tax deferral. You don't pay income tax as the value of that policy goes up. So there's no income tax on the interest that you get while your account value grows. So you don't get a 1099 every year. There's no probate cost. No money goes to the lawyer for the probate, for probating your will. The money is distributed by the beneficiary. It's in the contract. It doesn't go through probate. The other thing about it is that the creditors can't get to it. As long as you have a beneficiary, a personal beneficiary name, the creditors can't get to it. If you name your estate as beneficiary, that's a different story because the money goes into the estate, the creditors can get to the estate. So as long as you name a beneficiary, you're in good shape. Okay, so there's one other choice. And this is single premium the whole life. It's an income tax-free family benefit. Okay, and we'll talk about that in a second. Safety, your funds are backed by the financial strength of the insurance company, just like the annuity. Has a competitive rate of return. And we don't talk about that very much, but there is a rate of return in there. Flexibility, you choose the terms of your contract with guaranteed lifetime income options, just like the annuity. Tax deferral, no income tax on the interest while your fund value grows. No probate costs, again. And if you have a beneficiary name, there's no creditors can get to that money. Tax advantaged proceeds. And we're going to talk even more about this. In the event of your death, the beneficiary receives the life insurance benefit income tax free. And that is a large benefit that life insurance has. The last thing here is create leveraged dollars. And what do I mean by that? You can increase your legacy dollars substantially. I'm going to show you what I mean. At age 67, we have an age 67 male who has $30,000. And we can take that $30,000 and turn it into a $60,000 death benefit. $60,464. And this is the illustration right in our illustration system. And so instead of having a CD or an annuity with $30,000 in it, he's got 3 kids, he wants each kid to get $10,000. We can put the money into a single premium whole life policy, and each kid can get $20,000 instead of $10,000. Or each kid can still get the same $10,000, and we've got an extra $30,000 that we can give to the church or to the school or whatever our favorite charity is. So that's what I call leveraging the dollars. We've taken $30,000 and turned it into $60,000. And yes, if you need the money and can't go all the way out to the death benefit, there is cash value to this policy. And by the 4th year, you have, end of the 4th year, you have equaled the money that you put into it. And by the 10th year, you're actually making about 2% on your money. And by the 20th year, it's about 2.3%. And that's what I talk about when I say a rate of return. If you would put $30,000 into an interest-bearing vehicle, and you had, at the end of 20 years, you had $47,732, that would be about 2.3% return on that $30,000 initial deposit. So these are the ways that you can talk about our life insurance products. It really makes sense to people when they see these numbers. They have total control of their money. They, even after the second year, they still, they can get to $28,000 if they need it. They can take a loan on this policy, or they can withdraw some of the money and lower the face amount. So there's a couple of different ways of doing it. And it goes all the way out to age 121. And the cash value is $60,000. It's a face amount at that point, $60,464. Again, when I started in the insurance business, the end of a policy was age 95. Now the policies go out to age 121, and who knows what the future holds. I always thought 95 was kind of old, and then my mom lived to age 98, and I'm getting there. So it's not that old anymore. So now when we get through the conversation, I said all I need to do is a little bit of paperwork. There's a free paramedical for you and a year analysis, and it can be done here at your home, or you can go to a clinic if you'd rather not have it done here. So what would you prefer? Okay, and to go back, I need to go back a second here. Okay, so again, this policy, the premium was $30,000 and the death benefit was $60,000. When you look at what you need to get medical requirements for, it's not $60,000. It's what's called net at risk. And the net at risk here is a $60,464 minus $30,000. So we need medical requirements for $30,464, not the whole $60,000. So that's a little bit of a break there. So, are there any questions on any of this material that I've gone through? Okay. Again, we're talking about buckle up for safety, buckle up for the future. That's going to be our theme for the next month or two. You're going to see that. It's a great opportunity for you to talk to people about insurance for their children. It doesn't have to be the term to 25. It could be the 20 pay. Now, the thing about the 20 pay is we do not have a guaranteed issue rider on that. The guaranteed issue rider is on the LP 65 and the LP 90. So keep that in mind. So, no questions. I thank you for your time today. I thank you for what you do out in the field. And I'm fairly new at PNA. I've been here almost 7 months, but that's fairly new in my estimation. But I read a book by a man by the name of Don Pincus, and he lives up in Milwaukee. He's a member up, lives in Whitefish Bay. He was commissioned by Mr. Spula to write a book about the history of PNA, and I read that over the last weekend, and it is an amazing history. You can be very, very proud of the history of the PNA and the PAC, which is they're intertwined, and what they've done for the Polish community and for the the Polish the country, Poland, what they've done. It's it's quite impressive. I would encourage you to read the book at some point in time if you haven't. And I just, it's kind of opened my eyes to what a great opportunity we have here to keep the legacy going. So again, if you have any questions, we'll be happy to field those. Otherwise, thank you so much for your time. Oh, the name of the book, sorry, is Yesterday, Today, and Tomorrow, PNA.
And yeah, and we have it available. If you're interested, please just let us know, and we have it available. Please make sure if you would like to, you have some questions, comments, or suggestion, please unmute yourself. Please unmute yourself. Make sure that that we could hear you. I think Pani Bravo wants to say something. Oh, hold on. Let me try. Let me see if I could unmute.
Ask him.
Yeah. Pani Renko, you have to unmute yourself. We can't hear you. We can't hear you. Sorry about that.
Okay, what about that?
There you go. Thank you.
Can you hear me now?
We can hear you now.
Okay, there's a lot of people asking, if, they have a life insurance and if they go to nursing home, what is happening with the life insurance? The state can take, the life insurance?
That kind of depends upon the state, because the state, there's different rules for different states, but frequently the people actually have to cash those policies in, and there's not a whole lot we can do it, or they can reduce the face amount to a certain amount to come within the requirements of the state. But some of them will allow the life insurance policy. Some of them want to have the policy like assigned to them for because they may be on Medicaid in the nursing home. And once a person is on Medicaid in a nursing home, it gets paid for, but that doesn't mean that you don't owe that money back to the government. So they will, if a person dies in the nursing home or assisted living facility, they still want their money back. So.
Because, I have a lot of questions, when they're, talking to the people. This is all.
Okay, what state are you in?
Connecticut.
Okay, well, what we can do, we can get the state laws for you and make sure you know the answers to those questions.
I would appreciate that. Thank you so much.
Okay.
Would you do the same thing for Michigan? I wasn't aware of this.
Also, if I may jump in, I think, Tommy, you had told me that, like in Illinois, if you change the ownership, ladies and gentlemen, I think 5 years prior.
Oh, okay.
Yeah, there's a look back.
Yeah, because of the 5-year look back period. But let's say if my dad has a life insurance policy and he makes me the owner of this policy, but it has to have the certain amount of time, then I am the owner, I'm controlling it. That means this is not his assets. I had some comments in that respect. Also, some states, when I was talking to the clients, some states also allow beneficiary to be a funeral home.
Mhm.
And that is being right away, removed from that pile of their assets.
Oh, okay, thank you.
Good question.
Any other ones?
I didn't realize. Oh, geez. Can you hear me?
Yes.
Yes, Mr. Martin, yes.
Oh, I didn't realize that they could attach. Could you send me the regulations for Michigan?
Sure.
I appreciate it.
Absolutely.
Okay, thank you so much.
You're welcome.
Okay, everybody. Well, thank you so much for your time this afternoon, and we look forward to seeing you the next time.
Okay, bye-bye.
Yes.
Thank you.
Thank you.
Bye-bye.
Thank you.
Thank you.
Thank you very
Bye-bye.
much. Thank you. Take care. Take care. Have a wonderful evening.
Yeah, you too. Thank you.
Okay. Bye-bye.